And now for something completely different.
It's a Rich Bass World.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And happy Friday, everybody. This is Rich Rosso here in The Real Investment Show, here with Danny Ratliff. Hope you're all getting prepared for the weekend. Couldn't come soon enough.
Well, our house is already the weekend. Kids are off school. It was Friday yesterday. They're Saturday.
Why are they? Why? I mean, I'm a little disconnected from the whole school thing. Why are they off?
The long Indigenous Indian weekend.
Mm-hmm.
Oh,
yeah.
Is that what this is?
Well, Columbus Day is Monday.
We need a Columbo Day. Just one more day.
Everybody dress up in trench coats.
Yeah. Instead of just one more thing, one more day. We need one more day off.
I like that.
Mm-hmm. Well, hey, it was a good day yesterday. Today, Dow Futures, NASDAQ, I mean, everything's green today. There's this hope for fiscal stimulus still on the table. Markets love the hope. Mnuchin and Pelosi still going at it to see exactly if they can broaden the stimulus bill. That sort of keeps the market, just chugging along until, I mean, all you have to do is just keep the carrot out there that it might be coming, and the market really appreciates that.
Oh, they have become master puppeteers. I mean, it is really about just the illusion of what may occur.
Uh-huh.
And it seems the market is just, it reacts favorably every time. I mean, the Fed has gotten really good at working their verbiage. And you're seeing politicians as well. And Mnuchin is falling straight in line with that, too, in the sense that they know what the market wants, so they don't always have to give it to it. But they just have to say, well, this may happen. And here we are. So, hey, I'm okay. I like markets up.
I do
think
too.
great days.
Green's a nice color.
Yeah,
I'm okay
green's
with
a
green.
great color.
I mean, I like red too around Christmas time, but otherwise green's a nice color. But to your point, Danny, it is. I mean, markets tend to have, or investors over time tend to have a bullish tendency, or especially when you have Fed stimulus and everybody on your side. It's just like having that. There's this old Twilight Zone episode with Bill Mummy from Lost in Space, the kid. But Brent, you'll probably remember this episode. It's one of the best. But the kid could make, if he was angry, he could turn you into stuff. So everybody was on pins and needles around this kid. Like if he wanted cookies or he didn't want to, and everyone was like, I don't care, Danny, or whatever his name was. You know, I'm tired of you. And like all of a sudden the guy disappears. Like the kid gets this look, and you remember that? So everybody's on pins and needles. Why doesn't anybody love me? So the whole thing is the market has become this kid, and everybody tries to appease it, no matter what. People know what to say. It doesn't matter if it's a politician. Like you said and Michael said yesterday, the Fed has become excellent puppeteers. They understand exactly what the market wants to hear. And it pretty much drives everything. And again, I like when markets are up. It's funny, people don't understand sometimes the counterintuitive nature of markets, Danny. Like sometimes when the event does happen and the market sells off, because sometimes it sells on the news, right? It sells, well, it's happened now. What's the next thing? So rides up on the anticipation, sells on the news. Just like when sometimes companies issue great reports and you go, how's the stock down today, right?
Forward guidance was poor, yeah.
Yeah, so it's just, you know, that's what's tough about markets, and that's why you have to manage your emotions sometimes in the face of them, because it's so counterintuitive sometimes to what you're thinking or even what you're seeing in the real economy. And if I didn't read so much market history and understand it even through the Great Depression and how markets performed, but then you finally start to get it, how the market looks way forward. And sometimes it is not the economy. I know that's a big talking point a lot of times for politicians, that the market isn't the economy. But let me explain. Yeah, maybe about 50% of the population owns stocks. But what I told a friend the other day is, who works for a big company, He goes, I don't understand. We need to help the general economy. The market's not the economy. I said, but let me explain. If your company stock doesn't do well, and all of a sudden the C-suite has to make some changes because of this, it does affect people who don't own stocks possibly, but they are employees. In other words, in some way or another, you're affected by the stock market. Because if you're working for a company that trades on the market and they're not hitting their numbers or whatever it is, employees are one of the first things that are going to be examined and possibly let go. So even if you're not investing in stocks, you are affected by the market.
Yeah, and that's
It's
the
an
one thing.
all-consuming beast.
It is, and it encompasses so many things more than just the stock market. That's the crazy thing about this is that, we want to equate these things. We want to rationalize, and I think that's the most difficult part.
That's the thing. That's a good word, rationalize.
Yeah, and many times we can't, and which makes it even crazier. We can't rationalize, the Fed's pumping money, but this does not make sense. Yet we know we need to participate. But how many people are on the sidelines, or how many people have been on the sidelines for the last 10 years who say, I need to get in now? And this thing can remain irrational typically longer than we can remain rational. Or like Lance will say, and who's the famous economist, says what the markets can remain irrational longer than you can remain solvent.
Yeah.
I can't remember who that is at this very moment. But regardless.
I thought that was Keynes, but
I think
it may not be. But the point is absolutely true. Once markets get in a trend, right, a secular trend, one way or another, it's tough to deny the move. So that's why when we get back, talk about an article I wrote the other day. One of my mentors, Jim Otar out of Canada, that sometimes these random walk. By the way, I don't read any books about the market when it's coming to random walk theories. Like the market's completely random. Markets follow trends. And even more so today when you look at correlations among asset classes. In other words, everything moves together. We get back, we're going to talk about that and many other things here on The Real Investment Show on 700 KCV, the voice of Texas. Stay tuned.
Go away, the bullets. Red leaves when the sound of the beat. Yeah. Another one bites the dust. Another one bites the dust. Another one gone, and another one gone. Another one bites the dust. Hey, I'm gonna
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Sometimes I ponder, read a great study the other day from a few doctors of how we really handled this whole COVID thing from an economic perspective, right? We haven't had a health crisis that has led to financial devastation. So the World Bank's come out and they said, okay, the economic consequences of the pandemic is going to change the profile of global poverty. Millions of new poor who are, by the way, relatively well educated in urban areas. So it's not, more than 80% of those who will fall into extreme poverty are in middle income countries. So the whole world seems to have just gotten into this fear trap, Danny. This is where globalism, like when during the financial crisis, that thread that is tethered through all of us creates this domino effect. Mm-hmm. Now we're seeing the domino effect, yes, and the virus is very real. And I know people that have gotten it, especially older people that I know that have gotten it. They've recovered, but they've had a tough time. So the global economy expected to contract by about 8%. The point is, I always will wonder, did we politically weaponize this virus globally and definitely not handle it properly to shut everything down? All these studies that are coming out now talking about the mental devastation, the financial devastation, which is almost equally as bad as the physical devastation, is going to be with us way after this pandemic is history. I don't know if it's a cultural thing or how we just, I don't know. The response to me was very hectic. If you didn't believe things should be shut down, that means you wanted people to die. That narrative came out for a while. But the economic devastation of this and the effects we're all going to feel, especially those that were maybe not even in poverty or were coming out of poverty nicely since, say, 2017, when the numbers really started to trend a bit better across the globe. We have just reset all that because of the virus. I don't think it's because of the virus. I think it's because of our response to the virus seemed to be...
Well, and
I can't put my finger on what happened globally because it's not just here.
It's not. It's been weaponized on both sides. You know, that's the problem with this issue, is that the response is going to be so bad from a financial standpoint. I mean, Credit Karma just came out with a new report, and they say that 1 in 5 Americans could be out of money by Election Day. Think about that.
1 out of 5?
1 out of 5. So 20% of people out there could not potentially make it to Election Day based on, you know, what they have in their savings accounts. You know, we've talked about financial vulnerability cushions. We've talked about making sure you have your emergency reserves. And for reasons, you know, we know the pandemic was coming. No. But we knew that there was some writing on the wall. And the issue is now how we've handled this. And Rich, I think that if you did too little, look, if anybody dies, you did too little, right?
Oh, absolutely. I mean, we do too little for everything. The flu, cancer. I mean, we do our best. But go ahead with your point.
Well,
but yes, I agree.
I don't think it matters because you were always going to do too little or too much.
Yeah.
In many ways. And this is such one of those tough things, and everybody has their feelings on this. But from an economic standpoint, this has been absolutely devastating. And that's why stimulus has been at the front of every conversation, especially surrounding markets. It's not even, you know, the numbers don't matter as much as long as there's stimulus there or there's some type of economic reform or policy that's going to help push this thing along. My fear is that when this thing runs out of gas or, you know, there's no efficacy to it any longer, that's when we have some issues. Because at some point that'll happen. I mean, think about this. If you look at all the numbers, if we look back and say, okay, we know where people are, where households are. Mm-hmm. How long can this support? Are we really going to bandage this and we're going to be able to bridge that gap until the economy really gets back up and running again? Because what if it doesn't get back and running to where it was?
Well, and to your point,
that may not matter though.
All we do are bandages.
Yeah,
we don't.
There's no
structural
reform.
And a vaccine is not it's not the solution to everything. Half people won't take it. Who knows what happens with the other half? This is with us forever.
Yeah.
We have to find ways to adjust. And I think we probably could have done it intellectually calmer up front. But somewhere along the line, the politics got involved.
The media got involved,
Well,
too.
the media, yeah, and poisoned it. Because every case of COVID was a death. That's not true. Every case of COVID is not a death.
Or every death was.
Oh, anyway, yes. But I'm saying it's a linkage.
Yeah,
if you
very
had
true.
COVID, it was a death sentence. I'm not saying it's not pleasant. Listen, I had the flu 3 years ago. And I said to myself, and I'm not comparing this to the flu, I'm just saying virus, and I had the flu. And I remember talking to my daughter, I said, you know what? I understand why people died of this thing. I mean, it is miserable, so I can't imagine how bad COVID must be and the after effects. But I also understand that there's economic devastation, and there was a better way for us not to just collapse the economy. But that was the solution at the time, and it was supposed to be temporary, and then all of a sudden it became more permanent. And how do you wait for a vaccine? this is an economic talk, by the way, not a political one, because it comes down to the fact that there is going to be damage. This is why we created Candid Coffee, by the way, where you have to come up with the battle plan for your household. All these traditional rules of thumb, like what percentage of your income should be mortgage, how much I should have in discretionary expenses, whatever the junk. These rules, which are still being used, do not apply. We created our own even before the pandemic. Like what percentage of gross income? Like Danny knows I've been looking at a house in his neighborhood so I can harass him, right? Be Uncle Rich, babysitter, come on over, feed the dogs, do whatever you got to do.
Come on.
Hey, listen, Uncle Rich is fun, by the way. I've got puppets. So the point is I looked at and I said, I figured out what kind of down payment I would need and to say to myself, I will not allow my mortgage payment to be more in net income, not even gross. So I took the net, more than 10% of my net income, which means now I had to reset myself and take the emotion out, and I have to save more for a down payment. What's the rule now? 28%?
28%, yeah.
Of gross income?
Yep.
And I've seen even that's going up to 30%.
Oh, but you see, when you go apply for a mortgage or go look at a mortgage calculator, stick your numbers in, and next thing you know, you're going to see it's going to be well above 28% of what they're going to say. We can lend you this. You can afford this. And that's the part where I think people get in trouble.
Yes.
Because now all of a sudden we feel like, oh my gosh, yeah, you know what? We do need this house. You know what? I'm going to get a raise next year. I'm going to get a bonus. Things are going great. Or, we're always optimists. And I love that aspect.
We do. We always look forward that we're going to do better. Mm-hmm. And Danny knows I was looking at this one house. I really liked it. I mean, this is a perfect house for me. I loved it. I loved it.
Yeah, you missed out. You should have done it.
But the point is, I got people like him telling me that. But I did my numbers, and I was a little higher than I would have needed to be. I was like closer to 15%. And I said, no, okay, I gotta eat. Someone asked us this question on Right Lane. Mm-hmm. Do you guys eat your own cooking? Well, they always think of it that way when it's the portfolio. Mm-hmm. But you also got to eat your own cooking when it comes to the financial rules that we share with you. How good would we be if we were in massive debt, we drove all fancy cars, if we were doing all these things, and yet preaching to you to do something different? So we eat our own cooking, not only on the stocks, like I'll own the stocks that we own, right? Mm-hmm. We also eat our own cooking from a financial planning perspective, right, Danny?
Oh, yeah.
So following those rules, I think everybody, Connie, Lance, me, you, I think we all are this way. We are good stewards. We are fiscally responsible. I will say our rules are tough. But if you follow them and you go to financial guardrails at Real Investment Advice, you will see that these will, over time, create this financial vulnerability cushion. And when bad times occur, you have much more of a clear head to make decisions. The worst part is, imagine having all these bills or living above your means, and all of a sudden you even get like a 10% pay cut. You can't handle it.
Yeah. And there's plenty of people like that, because what do we tell people when you get a pay raise? You don't go out and buy the next nicest thing. You don't go out and get a bigger house. You stick that money in the bank.
Nothing should change.
Yeah,
what should change is the size of your emergency reserve or your investment account, or I don't care if you want to buy rental real estate. Mm-hmm. Your investment portfolios should grow, not your expenses.
And look, periodically, I understand you're going to have some creep, and there's going to be things that you want to do, and that's okay.
You might step up once. I get that. For you doing things that you need to for your family, for taking an extra vacation, for doing these things. I think there's a fine line. There is a balance that you must have, and I think that's what's really important. That we even have to look at, Rich, in regards to you talk about how conservative you are, but there are times that you need to say, okay, you know what, we can bend this a little bit or stretch this, or we're doing a little bit better here, so now we can increase this a tad bit. But you should be writing this out, right? You should be saying, okay, we got this much more money coming in.
That's the key.
This is pen and paper.
Write it
work
out.
beautifully. Listen, I've been keeping a budget since I've been delivering papers at 12 years old. I still use pen and paper. I still have it, right?
There's something
works.
about it.
It still works.
Well,
Why am I
and
gonna
it's
change
also
it?
nice when you can check things off a list, like creating a real checklist. When you actually physically cross
Yes.
something off, there's
Yeah.
something to that instead of clicking something off on the computer, which
And
I guess we all
studies
do.
show that is absolutely the case. We get back again. We're going to talk about retirement income planning and a bunch of other stuff here on the Real Investment Show on 700 KCV, the voice of Texas.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live go-to-webinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Welcome back. Brent always likes to leave funnies on the computer. You compliment your friend on an awesome mustache, and suddenly she doesn't want to talk to you. WTF.
Why, what could have possibly gone wrong?
In my Italian neighborhood, every girl had a mustache.
And lifted weights.
For a while there, Haley had one. I was like, I just told my wife, I went, really? I think he's growing a beard. What do you think? She goes, I think so. It's Italian blood is this. So our next Candid Coffee is appropriately right before Halloween, October 24th. And again, this is our pre-election Candid Coffee. Policies, not politics. Because talk about emotions and Social Security. Woo. Emotions in investing when politics is involved, forget it. That's a horrible mixture. Lance wants to try to provide some objectivity, help you to understand what could happen, how markets react, regardless. And, of course, he'll be armed with charts, so I'm going to tell you, drink lots of coffee. That's Saturday between 8 to 9 a.m. He'll be in his Cobra Kai bathrobe for this. I love these Candid Coffees. We always have like 20 to 40 people show up, and we talk about, and again, you go to GoToMeeting. It's a GoToMeeting event. You go to Real Investment Advice. You register, ask your questions. We get some great questions, and we're able to informally just give you, hey, here's the lowdown. No spin. This is what you need to look at. Because again, as fiduciaries, we don't sell products. We're here to help you make good decisions. So we talk about everything: financial vulnerability cushions, Social Security, Medicare. I mean, gosh, we've tackled, I think, every topic. But the election, we thought, is going to be first and foremost on everybody's minds. So it would be nice to have Lance join us for this iteration of Candid Coffee and take your more investment-centric political stock questions or what you're thinking about what could happen. And, of course, if you're going to be you will say, you're hearing it already, right, Danny? I want to just get out of the market until the election is over. Well, it doesn't work. I'm going to tell you it
because you don't get back in, and we've seen people do that, throughout multiple election cycles. And the issue is just what you said, Rich, that somebody gets out, they don't get back in because they don't agree with the current political or the administration. And unfortunately, that's usually a mistake because we're letting emotions dictate this, not investment philosophy or what may actually happen. And many times, it may not even be the overall philosophy of an administration. It may just be that markets are cheap. Maybe you have a tailwind. There may continuously be a headwind, or you have the Fed. The Fed is the new, the Fed's a game changer. And that's one of the things that continuously can pump this for probably much longer than we're prepared for, right? Because everybody thinks that we've been waiting for this big downturn. And I think this is why active money management is so important, Rich, because that buy and hold aspect, we saw a 35% dip earlier this year. We've all forgotten about it because the markets have ran up. But we forget that these things can happen, and how quickly the markets recovered is not normal. Not at all.
That was, I will tell you, extremely unusual. And it is because of the unprecedented stimulus that was pushed into the system and the promise of that we will pretty much do everything and anything. Mike brought this up yesterday about the Fed crossing the line and buying stocks. Mm-hmm. And I'm sure I've said this on the show before, but a friend of mine, John Bott, he's a big hedge fund guy here for years. We went out for dinner during the financial crisis. I'll never forget it. And he said to me at dinner, he says, one day, someday, the Fed is going to buy stocks. And I laughed at him. I'm like, listen, come on. I mean, if that happens, the whole thing's manipulated. I mean, the whole reason we do what we do, all of this is going to change. Here we are, everybody. Here we are. If you think they bought junk bonds, if you don't think they'd cross over to buy index funds, you are wrong. They will do it. I am absolutely convinced that will happen. But I never thought it would at that point. I'm usually pretty good at trying to take in what trends might look like. But I just thought that would be a line, Danny, that would never be crossed. And I know it hasn't yet, but I will tell you, it's not going to surprise me if or when.
Man, what would Benjamin Graham be doing right now?
Oh, he's rolling over.
I mean, think about this. Think from a value perspective here. What is actually occurring? And to think that we won't let market cycles run their course. There's nothing wrong with these things. Yes, do we like to avoid them? Do we not want to suffer? Absolutely. But when these bubbles get big, they need to be burst. So you need to let the market cleanse itself and then get back. And that's where true value can be found. And that's the unfortunate part, is that we're just not allowing that to happen. I suspect we'll still see that. It's just a matter of when, not if. But, this is going to be one of those deals where, the Fed's just going to keep going until they can't.
You're going to need some form of catalyst outside of the Fed that clears up, as opposed to all these Band-Aids we do things, right? Some big structural changes and improvements, because when that happens, then the Fed can actually start to normalize or go back to doing what they do. But you need some big structural changes to occur. That's going to increase rates, economic activity, inflation a bit. And the whole globe is now stuck in, not only were they stuck in the financial crisis, and some households never recovered, now we're in this. Well, so I get the question all the time, well, how long do you think it's going to take for everybody to recover from this? I'm like, well, I'm going to say at least a decade. And I'm not talking about the stock market. I'm just talking about the overall economy and how people live. And it's a game changer. It's just what's the game and what the pieces on the chessboard are going to look like. But this is a game changer, and it's not going to happen. Oh, we're going to see recovery by 2022, whatever numbers are used. Yeah, okay. I heard that during the financial crisis. Oh, by 2011, it's going to be great. Okay. Hey, it is what it is, which means your life goes on. You got to understand that your ways of generating income from a portfolio are going to change. Markets move. So one of my mentors, Jim Otar, who's now retired, ironically, I think he's retired in a bad luck cycle. I mean, talk about where you retire in a market cycle is luck. And I'm talking about secular trends, 20 years, right? Long term. I think he really has retired in a headwind, but I think he'll be able to adjust because he writes about adjusting when it comes to retirement income. The key is, how are you going to do it? How are you going to handle a headwind in a market trend of lower returns? Now you already got lower returns on bonds, but I'm talking lower returns across the board, and not from year to year to year. I'm talking longer term trends. 10, 12 years, when you finally average it out, you go, whoa, gosh, maybe I made 3%. I can't take 4% unless I'm really going to cut into my principal. And listen, some people are going to be spending down. It's how fast they spend down so they don't run out of money, right, before they run out of life. This is the ongoing balance when you retire. And I believe people who have retired as early as 2018 have been in a headwind. So you have to have certain ways of looking at your portfolio differently, right, Danny? I mean, how are you going to create enough income to make sure that you make it? Not only that, you can't, if you're getting most of or all your income from variable assets like stocks and bonds, you have to examine those withdrawal rates. We do it every rolling 3 years just to see if we need to help somebody make a change to the withdrawal rate, lifestyle. Thank goodness we haven't had to do that. But there are a lot of people that are going to need to assess, because here's the thing. If you get bad market returns in the beginning of your withdrawal strategy, say you're what we call unlucky, and the first 2 or 3 years of retirement, Danny, you're pretty much spending principal. Well, that, and I have this in the article, and that's called sequence of returns, right? Your unlucky start gives you like an 8% in this illustration, 8% net reduction in your overall portfolio, as opposed to maybe the first 3 years, growth has taken over. Maybe my fourth year, I'm dipping into principal. My net reduction is only like 1.7. So keep in mind, if you have an unlucky start, that's worse than anything else, because that's going to dictate the longevity of your assets, which is why we'll talk about how we plan to make sure, if you are in an unlucky start period, what you need to know. All right, back for our next segment and last segment here on the Real Investment Show. 700 KSTV, the voice of Texas. We'll be right back.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Welcome back to the Real Investment Show, or the Real Investment Ship, as we're going to rename this.
Not the ship.
So
I like the Real Investment Ship.
I do too. Kind of like the mark. It's tough to get it off track.
We could start a club and designate people real investment ships.
Yeah.
But
Lance could go out there and look at when the water's all glassy and calm. He knows. And this, what is it? Red sky?
Red sky at morning, sailor take warning.
Yeah. So he'd be able to do those kinds of warnings.
Yeah.
Lance can be the captain. Rich can be the pirate throwing stuff at him.
We get to
regularly.
I want to be
a corncob pipe.
Harassing him. Yeah.
I'd be Gilligan. Skipper, the market's turning. Again, I think you will get very complacent here when it comes to markets consistently going up, because from year to year, you never know. But what we're seeing is, over a period of time, what we call a secular trend based on valuations, based on yields, and other factors that we look at, that you're going to have a headwind to returns in your variable assets. if you're in distribution mode, right, Danny, you have to watch your portfolio rate. Monitor it over a period of years. Micro budget the first year you're in retirement just to get a really good feel for what your expenses are. Run realistic plans, please. Again, in the article I wrote about that Monte Carlo simulation is not the end all. It has flaws. We use Monte Carlo. We have to overcompensate or compensate for those flaws by adjusting average returns, future returns on asset classes. So when we do these simulations around the return, we're making sure that we're giving you a good feel for what you're going to expect, right?
Well, it's not only just adjusting the returns, it's also adjusting standard deviation, what that may look
That's
like.
right.
Those are important aspects to understand volatility in markets and different cycles. And really, that'll play a big part when looking at Monte Carlo.
Long-term volatility, right, is an enemy of retiree.
It is. Oh, yeah.
Yeah.
I mean, it can be your friend as well.
If you're an accumulator,
Yep.
if you're young and still putting money away, you may like that because you're going to you're going to get stocks at a low price. It can be very distressing as a retiree, and I'm taking money out of my accounts. So you need a strategy for that. But yeah, go ahead.
No, I think it is. And, you just said something. For accumulators, it is frustrating because you may put in cycles where it just doesn't feel that great. Markets are down. And I think a big mistake many people make, especially an accumulator, is they stop making those contributions. I mean, I can't tell you how many times in different economic periods where things have been choppy or volatile, I've heard from people say, oh, yeah, I stopped the 401k match or contributions. Like, whoa, why? They say, well, I'm going to wait till the market gets better. Well, that's not necessarily what we want. That means if we're going to wait till the market gets better, it means you're going to buy it at a much higher price. So while we're very big advocates of active money management, we're also advocates of, putting funds to work when markets are cheaper. Yet, look, we're never going to know. Nobody is the exact bottom of something. But if we know that longer term, if things are cheaper, that's probably when you want to start buying, especially if you're an accumulator. But like you mentioned as well, if you're on the opposite end of that and now you're in that distribution mode, that can be very worrisome. And I think that's where, we have to be cautious and you have to have a game plan together. I think the biggest question from a lot of retirees that we get is, okay, well, how should my allocation look right now? One, I think it depends. It's a little bit different for everybody because one, we're going to go back to, and this is so like, we do a lot of different television interviews. And I'm probably one of the most boring interviews when it comes to, okay, what should somebody do? Well, first of all, I'm going to tell you, I'm going to be a broken record. It should start with a plan because I don't know from an individual perspective. I can give you very broad generalizations, but you need to know what are your expenses. You need to know what your budget is because that's how we're going to back into what you need for your emergency fund, what you need for your financial vulnerability cushion. Now we're going to say, okay, let's start backing into stocks and bonds. Are markets expensive? Are they cheap? Where are interest rates? There's so many variables that I think that many times we can do everybody a disservice by just saying, oh, here's what you do. And in general, when we're talking to the masses, that's probably the best thing to do. But if you're listening to this and you're thinking, what can I do for myself? This is what I would tell you to do. And when we're looking at these cycles, especially if you're just getting into retirement, I think we need to get into practice mode if you can prior to retirement. And now I know a lot of you guys out there are kind of going through that from a being furloughed, or maybe you've just been laid off. You still have unemployment. This would be a great time for you to really do a deep dive into your budget because then you can start to see what you really need. And we want to break each and every one of these different segments down. And I think this is where it's really important, Rich. And by making, this is where our most successful people in retirement, they have a very good understanding of where things are because then you talked about, being frugal and kind of throwing out the rules of thumb. And I think this is important because it's not about doing that. It's about having security, having freedom to go and do what you want. That's the same thing we want our clients to have in retirement and to have that peace of mind, knowing that different market fluctuations, while we don't like them, they will occur. We're not ever going to be able to completely avoid them. But you're prepared and moving forward because you've done all these things like you mentioned in your article that have prepared you for this. And I think that's going to be the biggest key.
Well, you brought it. I mean, you said it, Danny. The plan is so important. Imagine having the peace of mind to know the kind of return you need. Forget the market return, forget everything, but the kind of return that you need to hit your goals. So I worked with somebody a couple of days ago, and their benchmark rate to hit their goals, very reasonable goals, was about 2.5%. That's what I call a step over hurdle.
This is what our hurdle rate is.
Right.
Yeah.
A step over, though, because it's so easy. In other words, if this individual gets 4%, they're styling. Even
Yeah.
if they get 3%. Why did they have such a low hurdle rate? Because they're good savers. They manage debt. They have reasonable lifestyle expectations. So if they get 6, 7, 8% return, even in 1 year, and they really exceed their hurdle, they're just going to get to their goals a lot faster. Or guess what? Their goals are going to grow wings. And what that means is they're going to be able to do a lot of other things or expand on their goals as opposed to shutting them down. Then I met with someone a month ago that I figured out they need about 7% to hit their goals, which means they're going to use the market to compensate for their bad habits. Through this cycle, through some cycles, that is going to work. The market can cover a lot of ills. This cycle over the next 10, 12 years, you will not make it. So if you need 7% return, we'll go. So I said, you know what I said? All right, you're going to get 3% from the portfolio. What are you going to do to get the other 4%? What are you going to do?
Well, and so that's what nobody wants to hear.
What are you going to do?
So you're going to have to either work longer. Well, so here's what it all boils down to.
How do I make that gap?
You're going to have to work, right?
Now this is this is a young man,
spend less,
40 years old, who's spending too much.
Yeah.
So all he has to do is cut his spending back. But to your point, he can make more money, right? He can continue his career path. You know, I said, here's how you can increase your skill sets, right? You look at your human capital.
Yep.
Look at your human capital. That's a great idea for an article, Danny, though. Make up the gap in the hurdle rate. How do you do it outside of your portfolio? Here is the metric.
Well, that's right. And so this is the number one thing.
Well, you were going through it, working longer. Go ahead and go through
So you're either going to be able to save more, spend less, work longer, die younger. I mean, which one do you want, right? You're going to die early? I know a lot of people are going to die at their deaths these days.
This real investment ship has sunk.
Sorry, guys.
Holy
very
ship.
bad news.
Holy ship.
So the issue here is those are the things that nobody wants to do. Now, the first two, either saving more, spending less, I mean, those are tied together, right? Those go hand in hand.
Yeah.
But this goes back to the one thing that nobody likes to hear either, because these are those things we know, but we're like, oh yeah, when you say these things, people kind of shut you down because they've heard it so many times. Pay yourself first. If you pay yourself first, you're going to have a much, much bigger penchant to not go out and spend additional money.
Danny,
because those funds are already set aside.
And all the rules we don't like.
Yeah.
This is the one we love, right? Because this one works. This pay yourself first rule is the best. I don't know who came up with it. I'm sure he's dead. No one talks about him or her anymore, but this rule is the rule.
Well,
it all starts from here.
That's exactly what you need to be doing. And you know what else you can do is start paying. If you have certain expenses that you want to make and that needs that you have or goals, set up a savings account for each and every individual goal, especially if nothing's paying you a whole lot. We're not really worried about everything compounding on top of each other, right? Mm-hmm. We can put these in different accounts and say, okay, once you fulfill it or you've met this goal or need, then you have a little bit of extra. And that's where you go have some fun. I think the biggest problem with financial planners is that, or the view of financial planners is that everybody views like, oh man, I don't want this guy telling me how much money I can spend. That's not our goal at all. Our goal is to walk by you and say, hey, as a consultant, here's how you can do this better. And here's how you can have more funds. You can have more freedom. And I think that's what it boils down to at the end of the day is that freedom and security that these things provide. And nobody's going to tell you what to do. You're going to do what you want. Now, we may tell you, hey, you may look at this a little bit differently. And I think that's what the key is that by doing this, seeing this so many different times, you do have ideas and you do see things that maybe that we don't. Because we get stuck in our own echo chamber, just like we talk about with social media, where we just hear and see and feel these things. And, sometimes it's good to step out of your own shoes and say, okay, what's another way to do this?
Mm-hmm. I'm going to start keeping a ladder in my office for people that need to make the hurdle rate. And if it's like 5-6%, I'm going to say, all right, here's what you need. You don't need my help. You're going to need to climb. I mean, a hurdle rate or your personal rate of return says a lot about you and your habits. That's the first thing it exposes is what you are from your money script. How you've been imprinted to think about money. that's one thing you have to remember. Who imprinted you about money? Who were the most influential people? Now, they didn't have to tell you anything. You could have just watched them. I watched my dad be horrible with money, and I totally had to go the other way. We're imprinted this way. Think about your imprint this weekend. When the ship comes back next week.
You just can't stop, Caney.
SS Roberts.
Just can't stop.
I will never stop being annoying. All right. Good weekend, everybody. Stay safe. Back next week. Thanks again for listening, watching on The Real Investment Show on 700 KCV. Take care.
Money, 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 always sunny in the rich man's world. All the things I can do.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.